It was widely expected that RBI Governor Shaktikanta would hold the firepower when it came to rates in the shadows of the Omicron variant of the coronavirus. And that is exactly what happened today. Status quo on rates, an accommodative stance maintained by the central bank, and a pretty optimistic outlook on growth. Consumer sentiment still continues to be a bit of a worry. Private investment is sluggish, and the governor spoke about these two things. Inflation is also an important factor that he touched upon, with inflation outlook being broadly in the tolerable range for the RBI, but in Q4, we can expect inflation to go up as high as 5.7%. Before we go into decoding the message coming in from Mint Street, let's listen in first to what Governor Das said today.
It is expected that headline inflation will peak in Q4 of this current financial year, that is 21-22, and soften thereafter. Taking into consideration all these factors, CPI inflation is projected at 5.3% for 2021-22, and this consists of 5.1% in Q3 and 5.7% in Q4 of 21-22, with risks broadly balanced. CPI inflation is then expected to ease to 5% in Q1 22-23 and stay at 5% in Q2 of 22-23. Our monetary policy stance is primarily attuned to evolving domestic inflation and growth dynamics.
All right, to speak more on this, I'm joined now by Kaushik Das, Chief Economist India at Deutsche Bank. Our Sivakumar, Head Fixed Income at Axis Mutual Fund, joins us on the show. And I'm also speaking today with Abheek Barua, Chief Economist at HDFC Bank. Welcome to all of you, and thank you so much for joining us. Let me begin, Mr. Das, with your overview of the announcements made today and what direction you think the central bank is taking when the world over there seems to be this tendency to tweak rates upwards, at least to control inflation. Do you think it's the right move to, keep off the trigger for now?
Hi, Tamanna. You mentioned that, the market was expecting a pause, but we were actually expecting RBI to increase the reverse repo rate by 20 basis points. And the main reason was because the current operative rate, is already at 380, and the reverse repo is at 335. So if the RBI had increased the rate to 355, it was completely expected by the market, and it would have been a complete non-event. So we were thinking that RBI would take this opportunity to increase the reverse repo rate, because if you see from growth standpoint, we have got a stronger recovery after the severe second wave. The July-September GDP number was higher than RBI's 7.9. It came at 8.4. And the last few numbers that we are getting on GST or PMI, all these things are pointing at the right direction. Only, thing that you can say that RBI did not do reverse repo rate hike is because of the Omicron related uncertainty, whether, things can blow out in the next 1 or 2 months or not. But that apart, if you take all the macro factors, and you mentioned inflation, just a few minutes back, RBI's inflation expectation survey was released, and it shows that 1 year ahead inflation expectations has increased to 12.6% from 10.9 in the previous round. So inflation is a concern. Growth is kind of coming back pretty well. So we were expecting RBI to increase. Now RBI has not done that, but if you read between the lines, they have actually increased the amount of liquidity absorption that they do through this thing called VRRR. And the operative rate I told you was about 380 currently. In the next few weeks or by end of December, that will go up close to the repo rate of 4% or close to 395. So reverse repo rate has actually become kind of redundant, and the short-term rates are already close to the repo rate. So these are my opening remarks. I'll stop over here at this point of time.
All right, let me go to Abheek for the same. Did you also expect a slight increase in rates? The reason I said that because there was clearly one point of view which believed that the Omicron has changed things and it will cause central bankers, including ours, to sort of think before, pulling back on the fuel for growth.
No, I think that was a sort of a legitimate concern of the central bank. But having said that, I'm just going to echo what Kaushik just said, that there were things that could have been done on the policy front, which is largely pertaining to this thing called the reverse repo rate, the rate at which banks park money with the RBI. And, that could have been done without, too many ruffles in the market. So I sort of couldn't quite understand why some of these, what I would call almost sort of technical corrections, were not done. And what happens if you don't do these things is that at some point, if inflation or something is out of control, you are forced to sort of accelerate your reversal in policy direction. So that becomes a risk. And the other thing, Tamanna, what you said is absolutely true, and that's something I noticed about the policy. Maybe there is no need to change the stance, or even perhaps telegraph a timeline for a possible change in stance. But the central bank narrative across the world seems to have changed from one of treating inflation as purely sort of a transitory supply-driven phenomena to one that is more permanent and embedded. And central banks have sort of changed their tack. The Fed is kind of accelerating its liquidity withdrawal, etc. So this was kind of out of sync with it. You could the RBI could have flagged the Omicron risk. We really don't know what's going to happen with that, but perhaps some more attention, to cut a long story short, could have been paid to inflation risks, given that the growth seems to be somewhat fine, if not fine, okay, fettle.
Yeah. R. Sivakumar, do you also think that there was reason and there was cause for a slight tweak upwards of rates, and perhaps the Omicron scare did not warrant the caution that we've seen?
Hi, Tamanna. So, yeah, I think I'm with both Abheek and Kaushik on this. I think the RBI could have taken this as an opportunity to raise rates. I'm not saying that it is a case where the RBI is putting the system on an upward rate trajectory. They are not likely to touch the repo rate for some time. This is a signal about the reverse repo rate, the rate at which the RBI is absorbing liquidity from the market. We must remember that most of the liquidity is currently being absorbed very close to 4% using the 14-day and other variable rate reverse repo mechanisms. The overnight repo or the reverse repo, which is at 335, is now a very small part of the overall pie. Therefore, moving the 335 would not have sent a very big shock into the system, given that a larger amount is getting absorbed close to 4%. So this would have been a great opportunity for RBI to move the reverse repo rate without it being disruptive for the markets. But I think the RBI is trying to send a very different signal by the pause, given that the market had widely expected some action on the reverse repo, and more importantly, some kind of guidance about the future course of action, none of which really transpired. So it was a very dovish policy from that perspective. And I think the core is the RBI still doesn't seem to be very confident about growth outlook. Just remember that for the last 2 years, from December 2019 to now, the average CPI inflation is very close to 6%. The whole course of monetary policy for the last year and a half, 2 years, has been driven by growth outlook and not being driven by inflation outlook. If indeed inflation was central to the RBI's decision-making process, we should not have been at 335 to start with. So clearly, and again, in the RBI governor at the press conference made it very clear that the primary focus is, in fact, growth. The deputy governor made it very clear that he expects that the output gap, which is to say that the sort of risk of overheating of the economy, is several years away. So the RBI seems to be quite confident, firstly, that there is no immediate risk to overheating the economy. More importantly, that they need to continue to support growth. And that seems to be driving the RBI. What is a real surprise is perhaps not that the RBI chose to pause. I mean, that's their prerogative. The real surprise is that there was absolutely no reaction from bond markets, or at least there was only marginal reaction from the bond markets to the policy announcement. which seems to suggest that even though the markets had gone in with reasonable expectations of a reverse repo rate hike, a relatively dovish policy actually didn't lead to any kind of market move. So from a fixed income portfolio management perspective, that is the real surprise to me. Of course, the stance of the RBI matters a lot for us in terms of bond markets, but I think the lack of the market reaction itself is somewhat telling.
Yeah, absolutely. Kaushik Das, let's switch focus to growth. Growth projections 9.5% in line, no major change over there. And with that accommodative stance going, what do you make of that? And where does it really point to in terms of a broader recovery story for India going into the next fiscal?
So, Tamanna, 9.5% growth is broadly in line with our own forecast is also 9.5 for this year. October-December quarter is already gone. So we have a forecast of 6.5. RBI has given 6.6. And January-March, they have given 6% odd growth for the next year. So 9.5 looks to be on target. The question is more from a FY23 point of view. We have a forecast of 7.5% for the whole year. Whereas IMF has given a forecast of 8.5% for India next year. RBI has given a forecast close to 7.8 for FY23 in their October monetary policy report. Now, you'll see that in April-June, RBI has taken 17% odd forecast, growth forecast for April-June 22, simply because in April-June of 21, we just grew at 20% despite having a very positive base effect because of the second wave that we had. So RBI is expecting growth to kind of go up sharply on a year-on-year basis. We have taken a little conservative number of 14% for April-June, thinking whether there could be some bit of problem related to Omicron. We don't know, but we have factored that in. But still, we are getting a number of 7.5% growth for next year. So, it looks more or less in line. And, inflation, as Shiva mentioned, is on the higher side. And RBI's target is actually 4%. And we think that after this COVID, India's inflation minimum would be 5 to 5.5% on an average, if not higher. So the question that we need to ask is that if we are stuck with 5.5% inflation for some time, and you have growth more or less coming at 7.5% for next year, should the repo rate be at 4% or the reverse repo rate should be at 3.35? Our clear answer is it should not be the case because 2020, our growth had collapsed. And that time, the reverse repo rate was cut to 3.35 and the repo rate was 4. So we would assume that repo rate would be hiked by 50 basis points to the course of 2022. But before that, the reverse repo rate adjustment will happen. And we think, RBI has kind of signaled in this policy itself. They have not made it very clear. It's a kind of, veiled kind of a statement. What they have said is that from the beginning of January, they are going to use more auction-based instruments to manage the short-term rates, and that could lead to the short-term rates, some of the short-term rates which are close to 3.35, like the call money rate, moving higher, and that would indicate that RBI will have to then just increase the reverse repo rate to 3.75, which anyway doesn't matter because the operative rate, as we discussed, has already moved more than 3.85 and close to 3.90%.
Yeah. Abheek, I'd like you to come in on this point. The sort of higher tolerance that the Reserve Bank is building to inflation. And I just want to couple it with one more point that the governor made, which was consumer sentiment is still dampened. And when you want to push growth, a dampened consumer sentiment and a sticky inflation, is that combination a cause for concern?
I think it certainly is, and Kaushik has explained the numbers and the technical details, and I'd just like to sort of spend a little time talking about the more qualitative aspects of it. So what we are seeing, I think, is that some pockets of the economy are doing extremely well. You take the case of some of the sectors that have received PLI incentives. I'm just back from Coimbatore and Tirupur, and the sentiment there is really, really buoyant. And for them, the China Plus story is playing out. There is a diversion of orders from China to their hub, to the textile hub, and this is true of other sectors, some service sectors like IT, BFSI, etc. And you see this manifested in salary increases, attrition, and so forth. So there's clearly one part of the economy that's doing well. The startup ecosystem seems to be doing extremely well as also. But I think that there are sort of question marks if you look at the pattern of demand and consumption, and if you look at the sort of the value ladder of products, for lack of a better phrase. If you look at sort of more mass consumed products, there seems to be sort of weakness in demand. And I think this example has been flogged to death, but the contrast between two-wheelers and their sort of very sluggish demand compared to the demand for cars, particularly mid-tier and upper-tier cars, is taken as an example of the sort of differential, which economists would perhaps want to describe as K-shaped recovery. So in this kind of a situation where it is possible that one very large segment of the economy, the informal economy, for the lack again of a better phrase, is not doing as well, so aggregate consumption is going to be a problem. And on top of that, if you have high inflation, then it's going to sort of dampen spending further. Now, on the back of the sectors that have picked up, you can sort of get growth, up and running for a couple of years. But if you are stuck in a situation where there is a large part of the economy which is not really recovered that well, and you also hit them with a higher sort of inflation level, a sort of an embedded permanent sort of higher inflation level, then you have a problem for medium and long-term growth. And I think that is my concern. And that indeed is a concern of a lot of companies that are, kind of distressed by this differential between one category of products, which is sort of the relatively high-end products and the low-end products.
Just to follow up to that, Abheek, what you've described is sort of in line with a report yesterday authored by Thomas Piketty, which talked about the widening inequality around the world and India specifically. And do you think that that's a concern which perhaps policy is not addressing?
I think inequality in India is this is a legacy problem, and if you just look at the shares of the top 10% and the bottom 10% and so forth, it's been worsening since 1991, and there is data on this. I think this government has recognized it and perhaps been very active, although it's been sort of often criticized as a growth chaser. It has actually done quite a bit on delivering social services, health, education, sanitation, etc., which could potentially bridge the inequality gap. But I think rising inequality and the fact that India is one of the most unequal economies in the world, going by Piketty's data, is certainly a problem, because inequality, even if you forget all the other dimensions, it puts a brake on growth, because beyond a point, if you have an unequal, a very unequal distribution of income, you are actually sort of depending on just a small segment of the economy to do the heavy lifting in terms of demand and growth, and that gets to be a problem. I think this government is very, very cognizant about it. It has tried its best, and it will keep trying its best. But there are issues of how to fund more social sector programs and so forth. But it's certainly something that needs to be still on the government's radar going forward. Growth is a necessary condition for doing the spending, but that is not enough. The distribution matters just as well.
Let me come to Siva on this, and we'll wrap this chat with a forecast on how long do you think the Reserve Bank can hold out from raising rates, maintain a tolerance to inflation, even as need for growth will continue?
after today's policy, we may need to reevaluate to some extent what the trajectory of rates would be. But I would say at the outset, first of all, that the RBI has already started the process of hiking rates. As I said, the variable rate reverse repos are cutting off very close to 4%. And with the RBI's own forecast for inflation for the next year, probably closer to 5%. And they are hoping that they can probably get inflation back down to 4% somewhere in fiscal 24. At least that was what the Deputy Governor's speech indicated a couple of months ago. So it seems that RBI is now looking at least a 2-year time frame for normalizing inflation, and possibly therefore a 1 to 2 year time frame for policy normalization. So we should expect that most of calendar year 22 will go in that process of policy normalization, which probably means if to go to a more classical RBI way of looking at it, which is to provide short-term real positive rates. So if they expect inflation to be closer to 5%, then your repo rate also should be at or higher than 5%. So we are talking about probably over the course of the next 3 or 4 quarters to raise the repo rates quite significantly. So I would say that it is probably a year-long process of interest rate normalization or interest rate increases. What we now need to see in the context of today's monetary policy is, firstly, that what gives RBI the comfort to pull the trigger on officially announcing rates, and it looks like that has to be a more comfort on growth rather than inflation. So inflation, as I said, has been sticky on the upside for quite some time, and that has not bothered the RBI so far. So it looks like what they need is some kind of upside surprise on growth, or maybe, for example, if this Omicron variant turns out to be a lot less impactful than what RBI fears, then they may have better confidence on growth. Of course, the second thing is that if inflation actually does run away, and this could be a global phenomenon. Fortunately, over the last few days and weeks, we are seeing some kind of retracement in the prices of many commodities, logistics costs, etc. So it is yet possible that we may end up seeing a positive surprise on the global turnout on inflation. So that is the risk to the other side of the wheel, that the RBI then has more time on its hand and doesn't need to do as much. So I think the risks are quite reasonably split. Of course, the risks are biased towards the raising of rates over the course of the next 12 months, let's say. And eventually that the RBI should take the repo rate closer to 5%.
Absolutely. So it's a wait and watch situation. For now, the benign interest rate regime continues and the focus remains on growth. That's the broad overarching message coming in from the RBI today. Thank you so much to all of you for joining us. But there's one more very interesting aspect of the many decisions and announcements made by Governor Das. And one of them was expanding the use and the portfolio of UPI, which has very soon become one of the most popular and fastest growing digital payment methods. Now, part of that plan includes extending this service to those without smartphones and people who have feature phones as well. My colleague Ankur Mishra has more details.
Yes, Reserve Bank of India has made several announcements on unified payment interface in the policy, and the first one being enhancing of limit or raising of a limit of investing in IPO or through RBI's retail guild platform. The limit has been raised from current rupees 2 lakh to 5 lakh rupees. Apart from that, Reserve Bank of India has also proposed a UPI based payment interface for feature phones. Till now, smartphone users are able to use UPI seamlessly. However, a person who do not have a smartphone, especially in remote areas in tier 3 cities or rural areas, where even internet is kind of a problem. So RBI has already allowed the research to be made under the regulatory sandboxing scheme, and few of the players has passed that test. So after those considerations, now RBI is going to allow feature phone based UPI payments. Apart from that, a discussion paper is also proposed by Reserve Bank of India for digital payments. A few of the consumers and the middlemen like shopkeepers have to bear the charges, and sometimes that charges are passed on to consumers. So what will happen to those charges? All that will be studied. All the stakeholders' view will be taken into account before coming to any conclusion by Reserve Bank of India.